Okay, good afternoon. Can you hear me? Yep. Okay, very good. Good afternoon to all of you. So this is future and options, 4 o'clock class. Okay. So I'm your tutor here for your 4 o'clock class. I'm referring to the way. So some of you might know me, some don't know me. So I'm actually a sessioner here in Taylor's. Monday, Tuesday is my timing. Wednesday, Thursday, Friday, I won't be around. So if you have any needs to find me or any needs of consultation, please email me to let me know. Make an appointment or you can ask me via email directly. Okay. So yeah, as you know, I already put this what do you call that, tutorial on YouTube Live. So that means it will be recorded on my YouTube. So if there's any need of reviewing or rewatching it, or you need assistance back to revise, you can always go to the link and the YouTube channel to have a look on it. Okay. So I see just now there are 31 students. Now we left with only 28 students. Maybe they realized they went into the wrong class. We left the class, I guess. Never mind. We just carry on with today's tutorial. I hope that you guys have the question with you. We will be doing on topic 1. Okay, topic 1. So let's start with our tutorial now. Is there any question so far before I start my tutorial? Can you hear me? I'm not using any rewind. I just say YouTube. YouTube. There's no rewind, and times. I'm not using all those or Teams or whatsoever. I'm only going to use Zoom, and yeah, it's running on YouTube Live now. So if you need, you can just go and watch it from there. Open this YouTube, you open this Zoom link. I'm putting it live there, so it will be recorded and it will be there. That's all. So I don't need to re-record it and re-download it and upload it again. Okay, the reason that I'm putting it live so that it will be recorded and for reference purposes, you can just do that. Okay, so just stay here in the Zoom link with me. It'll be better, it'll be smoother. Okay, in case of any connection issues. Yeah. The sound is blur. Where? Over here, the sound is blurred in Zoom. Can you hear me now? Yeah, you don't on the YouTube. You use the YouTube, it'll be a bit blurry. So just use the Zoom one. No need to go through YouTube. Okay, the YouTube is just for recording purposes. Can? Okay. Can hear me? Anyone having issue listening to me via Zoom here? Let me know. Right. Okay. So maybe if it's not clear, you might want to on a little bit louder on your speaker. Because so far so good. Okay. All right. So let's start with today's tutorial. I see 31 participants already. So let's start with the first question. The first question asks us, what is a derivative instrument? How is it different from stocks and bonds? So when you talk about derivatives, it's very simple. So I'm pretty sure you guys already went through what is derivatives. So what is derivative instruments? There are many different derivative instruments around. Okay. So basically this unit will focus on futures and options. Okay, and also forward. Forward is the classic version of futures, basically. Okay, and of course there are many other derivatives out there. There are swaps, okay, and some other less known derivatives too. All right, so we will be focusing basically on these three: futures and forwards, and also options. All right, so basically, what is this derivative instrument? So derivative instruments, if you speak it, if you explain it into a regular non-financial background explanation, it basically means a voucher. Okay, a voucher. So having a derivative instruments means having a voucher to buy something at a fixed price. So what does a supermarket voucher give it to you? For example, Tesco. They sell you a $10 voucher to buy oranges maybe. So you will be carrying around this voucher that worth $10 to buy oranges in any Tesco outlet. Okay, but of course, you pay $10 for this voucher. It's equivalent to your value. Okay? So that's basically what is derivatives about. Derivative is an instrument or a voucher for an underlying asset. So you don't buy the assets directly. You buy a voucher for that asset in the future time. Okay, that is derivatives. So now they ask you, how is derivatives different from stocks and bonds? So what is stocks and bonds? So I think a lot of you are familiar that stock is basically the company equity, okay, or the stock market. All right, company equities or stock markets, and bond are something that company issued if they have no money. Okay, they issue a bond to you, so they are indirectly they are borrowing money from you. You are lending money to them. It's a promise to you. So stocks and bonds, if you want to explain in the supermarket term, is basically you walk into the Tesco supermarket and you buy something cash and carry. So you buy something, it belongs to you, and you just go home. Okay, you pay for it and it's yours. So that's stock and bonds. Okay, so cash and carry. Whereas derivative instruments means you go to a small supermarket, you're not buying anything yet, but you purchase a voucher to buy that particular assets or commodity in the upcoming visit, maybe. So that's the difference. Okay, that's the difference between the derivative instruments and stock versus bonds. Okay, so remember this. Stock and bonds are basically cash and carry from the market, whereas derivative instruments is go there to buy a gift card or to buy a voucher for future purchases. Simple. That's it. Couldn't attend the morning classes. Most likely you will miss your attendance. You cannot take down your attendance. That's the only downside. I wouldn't mind you joining any other session, but missing classes means you're missing your attendance. So you might want to send an official email to notify me regarding this issue. Okay. All right. If no issue, then fine. Okay. So let's carry on. Huh? So that's basically question number one. Any questions so far? Anyone are having any doubts? Or don't understand what I'm telling you just now? So if you want the textbook definition or the textbook answer, you may always refer to the textbook or even the lecture slides. Okay, or you wait for Prof Said to upload the solution, and then you can download it on Moodle. Okay, so when I deliver in my tutorial or in my class, I'm trying to use it or relate it to reality as much as possible so that students could under the mechanism or the concept behind it. So it's not towards replicating the answers from the textbook. So if you needed the textbook answer as a reference or definition purposes, please refer to the textbook or the uploaded solution. Okay. So for now, if I see that if students did not stop me or did not voice out any of their concern, I assume that you'll be fine and we'll just carry on. Okay. So if you have any issues, stop me. Or if you think that I speak too fast, you need me to repeat, please let me know. All right. So that's it for question number one. Simple, very straightforward. So going on to question two. The evolution of derivatives instruments means that each new derivative is an improvement on its predecessor. State the operational advantages of futures over forwards and options over futures or forward. Okay, so first, futures versus forwards. You need to know the differences between these two. Okay, futures few of the criteria here. Futures is exchange traded. Futures is exchange traded. Whereas for forwards, it's OTC, over the counter, or more towards customizable. Don't put this customizable, it's OTC, over the counter between two parties. Okay. Next, futures is standardized. Forwards is customizable. Okay. Following up, what else? Futures got no risk. Okay. Forward, counterparty, or default risk. Okay. All right. So these are some of the criteria. There are more of it, of course, but I'm showing you these three now so far. So what has been an advanced movement or improvement from forwards to future? Okay. So number one, exchange traded versus between two parties over the counter. So this is to overcome the problem of multiple coincidence of needs. Okay. The improvement here is multiple coincidence of needs. All right. Being exchange traded means there are a lot of choices there. A lot of availability choices on the board there. Whereas forwards is between two parties. If the counterparty customizable. Okay. Whereas for forwards is between two parties. All right. So if the counterparty are not agreeable with your criteria, then there will not be any forward contract going on. So in that case, it's very hard to have a pairing. Okay. So whereas in futures is exchange traded is on the board, there's different maturity, different commodity, and different volume. So this will be having multiple coincidence of needs. You can find the best pairing for you yourself. Number two. Okay. Number two. Potential price squeeze. Okay. Potential price squeeze. So having forwards, all right, having forwards is basically, again, a customizable contract between two parties. So the prices are basically, you agree whether each of the parties agree with it or not. If nobody agree with it, the price will not reach a negotiable terms. Whereas in futures, there are different variety of prices there. So there will be a potential for price squeeze is still using forwards. Whereas future, no. Okay, you can choose the best price that you wanted. And last one, okay, the improvement from from forward to future is the risk. Okay, in futures there is no risk because there's an intermediary between two trades, so there's no risk. Okay, as for forward, is between two party only. So party A and party B. So party A agree with party B agree with party A. But on the delivery of the date, party B disappeared. So what happened? There's no transaction. So there's a default risk. Okay, this is basically the upgraded improvement from futures, from forward to futures. So futures is the upgraded version of the forward contract. Okay, looking at the second part of the statement, they call us to compare options versus futures or forward. Okay, options versus futures and forward. There's only one main benefit here. Options will be better off than futures and forward. In what way? The first thing, options is much more similar to a voucher. So take it as an example now. Okay. If you now, this is now, you want to buy gold. Okay, you want to buy gold at $100 per gram in 30 days. All right. So now you go into this transaction, you lock yourself in the future or forward contract. 30 days later, okay, 30 days later, you must pay $100 per gram of gold. So you spend $100 irregardless you want it or not 30 days later. But for options, now, okay, you want to buy gold at $100 per gram in 30 days. Okay, so this is the rights that you have. In 30 days later, you can buy gold, okay, at $100 per gram. All right. So for this benefit or for these advantages, you purchase this right with a premium. We call it option premium. So for example, for this transaction, you maybe pay $3. So I pay $3 so that I can buy gold in 30 days later at $100 per gram. So this is like a deposit. It's like a deposit. 30 days later. Okay. 30 days later, gold price is only $70 per gram. Okay. Gold price is only $70 per gram. So you initially can buy gold at $100 per gram. But now 30 days later, the market price is only $70 per gram. Ah, man, I'm not going to buy. I'm not going to spend $100 per gram. I could just buy $70 per gram. That means I only spent 70 bucks. Okay, plus this $3. So for me to buy one gold 30 days later with options, I only spend $73 per gram of gold. So in this case, my deposit I burn. I don't care. I lose the deposit, but I'm not obligated to execute this. Okay, but if I'm in a futures or forward contract, all right, I decided to go into the trade, the contract to buy $100 per gram in 30 days. Even though 30 days later, I realized that gold is only $70 per gram, I cannot cancel this transaction. I must pay $100. So it's $100 versus negative $73. That means minus 73. You spend 73 here versus spending $100 here. So the upgraded version, options, means what? Very simple. The conclusion here is with options derivative or options, with these options instrument, what you can do is you can choose to execute. Okay, you can choose to execute at maturity. Forward and futures, you cannot choose. You must execute at maturity. Can understand this story, you know, the mechanism behind the options versus futures and forwards. Okay, so hopefully this gives you a better insight on what is the how does this derivative function? What is the differences between both of them? Okay, so just remember, only options you can choose to execute. That means you're not obligated to execute it. Whereas futures and forward is a must, and maturity you must execute it. Okay, that's the keywords here. That's the important points here. So all right, so I see no questions here. So if there's no price quiz just now means better deal, right? Yeah, better deal. Yes, you're right. Okay. So any issues, please voice it in the chat. Okay, don't be shy. So moving on to number 3. Number 3 is a very common question. All right. They like to ask you, what are the key categories of players in the derivative market? So players in the derivative markets. So there are three players. Remember this. Number one, hedger, speculators, and arbitragers. These are the three main players or the three players in a derivative market. Okay, so to explain them in depth, what are hedgers? Hedgers are people who seek for risk reduction, or they want to manage their risk. Hedgers are people to try to run away from risk. They want to manage their risk, minimize their risk. Okay, speculators is the easiest to explain. They are the gamblers. Why are they the gamblers? They are gambling on the movement of pricing. Okay, they are gambling on appreciation. They are gambling on depreciation, depending on the movement. Okay, so basically, they are just gamblers. They got no support behind them. They got no risk to manage. They just go into the market to be gambling. They are speculating. Okay. Last one, arbitragers are people who make profit from mispricing. Okay. Arbitragers will only exist if there's mispricing. So simple. So let's talk about these arbitragers. Okay. Because in this unit, as you go on, every single derivative that we will talk about, different type of derivative or different type of futures we talk about, there will be a section called arbitrage. So in this unit, you will either talk about hedging or you talk about arbitrage. So when it comes to arbitrage, there are three things that you must remember. Okay, it's not available on the textbook. These three things is being simplified by me for many, many years and being introduced to the students for many, many years too. So those who taken my previous unit into the finance or even CF or whatsoever, you may hear this before. But those who are not here before, let me tell you, what are the three things of an arbitrage? Confirm must happen. If it did not happen, it won't be arbitrage. Number one, there must be a mispricing. If there's no mispricing, there's no arbitrage. Number two, under arbitrage, you don't use a single cent from yourself. Okay? So if you need to buy something, in other words, when you need money, you borrow. When you borrow means to pay interest, definitely. If you gain money, or if you get money, or you receive money in advance, you lend. What is the reason? To earn the interest. Simple, remember this. In an arbitrage, you don't take out any money from your own pocket. If you need money, you borrow. If you have extra money, you lend it to people. You want to gain the interest, you want to maximize the arbitrage. And lastly, in arbitrage, you will be confirmed profit. Confirmed profit. So if you're doing an arbitrage question, you get losses or you get a negative figure. Redo the whole thing. Something wrong with your strategies. Okay? It shouldn't be a loss. It must be a profit if there's an arbitrage. All right, this is extra. This is not related to the question. So the question basically talks about the three players only. Hedgers, speculators, and arbitragers. And what is the description for them? So hedgers are, they want to manage risk. Speculators are gamblers, and arbitragers, they are making money from mispricing. All right. So question 4 is very relatable in this sense. So question 4 is telling you, how might the absence of speculators or speculations hurt the hedgers? So if there's no speculators, what happened to hedgers? There are two scenarios here only. Number one, when there's no speculators, they become not liquid. No people to take the risk. Everyone is managing risk. Who is going to take the risk? So the market is not liquid. You want to sell something, no one buys it. You want to buy something, no one sells it. Because no one wants to go against the movement. So it's not liquid. Okay? Number two, without speculators, you got no counterparty. That means no one to accept your trade. It's quite similar to the first one. But the first one basically not liquid, you cannot sell off, you cannot buy anything. Okay, number two means no counterparty, no one to accept your order. All right, this is the two incident here. Okay, when there's no speculators, hedgers could not even hedge. There's nothing to be hedging off. No one to accept their counter offer. So when no one accepts, they are stuck there on the trades. They are no trading going on. All right, you need a gambler to take a risk-averse person offer. If everyone is scared of risk, no one there to take the risk, then there's no transaction going on. Makes sense, right? Right? Are you all okay? Can you all follow or not? All right. Okay, good. Good to see some response at least. Speculator part. Which part you want me to repeat on the speculator? The gambling part or what? What do you want to know about the speculators? Jensen. How the speculators work? They are gamblings. They doesn't work anyway. So they just assuming that the market will goes up, then they go and buy it now. So if they assume the market will goes down, then they sell it now. That's what speculators do. They are just follow their gut instinct. There's no supportive evidence towards it. They are just predicting the market. They're just looking at the trend, looking at the volume, and they assume it's going to goes up, then it goes going to buy. They assume the market's going to go down, they start selling. So that's how speculators work. They're gambling. Okay? So there's no basis to their decision. They just do as long as they feel it's right. All right? Okay. Coming to question number 5. Question number 5 here, they're asking us about differentiate between commodity and financial derivatives. So commodity, all of us know what is a commodity. Commodity are basically tangible assets. Okay? Tangible assets. Tangible assets such as what? All right. Raw material. Okay. Raw material such as what? Gold, silver, soybean, wood, metal, exactly, and etc. Okay. This is commodity. All right. Then what is financial derivatives? Financial derivative is basically intangible assets. Something that is not physically there. So things like forex, okay, stocks, bonds, cryptocurrency now, and etc. Okay, so they going to differentiate between commodity and financial derivative. Very simple. Commodity is basically tangible assets. All right, that will have a physical settlement at maturity. So you can see the physical product. Financial derivative, on the other hand, is just promises on financial instruments, such as this. So there's no physical assets there. So simple. So we know commodity is tangible assets. Financial is basically intangible assets or intangible instruments. Yeah, this is basically just the difference there. Nothing rocket science involved. What is the first word? What do you mean by first word for intangible asset? Yes, forex. Okay. All right, foreign exchange. All right, foreign exchange. Okay, so moving on. Moving on. Question 6. This one you might need to assist me, okay, to show some understanding on what you know so far about the type of risk and how do you want to manage the risk with the derivative instrument. So I will give you the risk here, okay? Outline some of the key types of risk and identify the appropriate derivative instruments to manage the risk. So I give you three risks. You tell me what to do. So first one is market, or we call it the price risk. Number two, interest rate risk. Number three, currency or exchange rate risk. So three different risks here. So market or price risk, what is this? What is this? Market or price risk means you're afraid that the changes of the prices will affect you buying or selling something, okay, at too expensive or under the market value. Am I right? Clear enough? So market risk or price risk basically fluctuation of price movement of a commodity that you're afraid it will affect your buying price and your selling price. So in this case, what kind of derivative can use to hedge this kind of risk? What type of derivative can we use to hedge market or price risk? Come. Futures. Only futures? Options? That's all? Options also. All right. So basically, when you come to market or price risk, okay, this kind of risk could be hedged with all type of derivatives. You can hedge with all derivatives, okay, but depending on commodities. Depending on the commodities. So you could use futures, you can use forward, you can use options, you can use swap. Yeah, you can use all the derivatives, depending on the commodities availability on the contract. Very good. Okay, very good. The next one, interest rate risk. You are afraid of the fluctuation of interest rate. So what do you do? What kind of derivative can you use? This one is part of our syllabus. In one of the tutorial, we'll talk about interest rate. We call it IRF. So I give you a hint here. So what kind of derivatives is that? Anybody want to try? Futures, yes. Interest rate futures. All right. For interest rate risk, you counter it with interest rate futures. Okay. In Malaysia, you use K-LIBOR futures. Okay. What is K-LIBOR? Kuala Lumpur Interbank Offer Rate. Okay. In textbook, you won't see K-LIBOR, you will see LIBOR only. LIBOR stands for London Interbank Offer Rate. Okay. So to trade interest rate risk, you use K-LIBOR futures or any other futures, LIBOR futures, or depending on location. All right. Coming to the last one, currency or exchange rate risk. This one, a lot of you traveled before, you should know. Exchange rate fluctuations, change different exchange rate in different country also. So over Malaysia, you might change a higher rate. When you go there, you get lower rate. So this is exchange rate risk. So how do you hedge exchange rate risk? Swap. Other than that, don't use swap first. Swap is passing the risk to other people. But now you're talking about reduce your own risk. Futures also. All right. Some more. In Malaysian context, in the Malaysian context. Cannot. So let me tell you some story here. Huh? So in the Malaysian context, okay, there is no futures in Malaysia. There is no exchange rate or what again forex exchange futures in Malaysia. Okay, in other words, foreign exchange or forex that people are trading now in Malaysia is also not legal or illegal, so it's in the gray area. So in Malaysia, you could only use forward contract. Okay, officially in Malaysia, you can only use in Malaysia. Overseas, different story. In Malaysia, you can only use forward contract. That means you need to find someone to agree to do a transaction with you. Okay, the easiest way to find someone to do a forward contract with you is the money changer that you see in Summit, Pyramid, in Mid Valley. Those foreign exchange traders. So they accept your offer or you accept their offer. That's a forward contract between you and them. Okay. But now, because of the extensive growth of internet and etc., there is also futures. But these futures is not really legal or illegal in Malaysia. It's in the gray area because there's a lot of foreign companies trading, traders or brokers around where you can exchange it. You can exchange it via the internet. Okay, so this is gray area. So basically in Malaysia, the official one is only forward contract. Okay, clear? So futures also can, but it's gray lah. Okay, it's gray. No right, no wrong. All right, you can see now everywhere. People are trading foreign exchange, but in Malaysia, it's actually don't have an official platform or legal binding rules that you can do though. You could do that. And you can see in your Facebook, in your YouTube, in Instagram, people are advertising about foreign trading, forex trading, and so on and so forth. So that's in the gray area. Okay, that's basically the 3 risks and 3 ways to use different derivatives. Okay. So now, going to question number 7. Question number 7 here, they tell you to differentiate between exchange traded, okay, exchange traded versus OTC. OTC means over-the-counter instruments. So under what circumstances might one prefer an OTC instrument to an exchange traded one? Okay, so you know exchange traded basically is talking about futures lah. This is basically the forward. Okay, so when will one person or when will at the other circumstances will one prefer to use a forward contract instead of a future? Okay, you will opt for a forward if you are heavily customizing the contract. Okay, you are specifically customizing a specific contract. Then you will opt for a forward contract. You got a particular volume, you got a particular assets that you want to hedge, or there's a particular demand for that particular commodity. So you are heavily customizing that contract. You might want to use an OTC instead. Okay, that's it. That's when you use OTC only. Other than that, futures will give you a lot more benefit, like what you mentioned just now. No risk, more choices. Okay, prevention of price squeeze. That means getting better offer or better pricing. But if you're going to OTC on forward, the more you customize, the more expensive it's going to be. It's just like when you go and buy a tailor-made suit and the ready-made suit. You walk into the ready-made suit shop that they already available sizes there. You just pick whichever most suitable to you, but it's definitely not perfect fitting, right? So you choose the one most suitable to you only and you buy it. All right. But if you talk about over the counter, it means bespoke. Okay, they measure your body, they measure your length of your leg, your hand, and whatsoever, your arm, and then they build one especially for your body. So customize it for you. So wouldn't that be much more expensive? Way more expensive, right? So just take this as the difference between futures and forward contract. Imagine you go to a tailor, okay, buying a ready-made suit and a tailor-made suit. That's the difference between futures and forward. Okay, can cannot? Are you okay or not? Or you think that I'm telling you too much of out of topic incident? They're gonna confuse you further. Can you deal with this or not? Can you deal with these external examples, or you prefer to just stick with textbook answers? Only Keith can understand better. The rest I don't know. Okay, if there's no objection, I will continue with this kind of delivery. So if anyone want to object or feel that is not suitable for you, you might want to voice it out to me. Then I tune it back to your liking. Okay? Because sometimes I don't know what students want. Why? Some says it's easier to understand, some says it's not, it's different from the textbook, it's confusing. Then you let me know. Don't be shy. Okay? So I will continue on. I'll move on now to question 8 now. Question 8 here, they call you to define what is meant by basis. So very easy. Basis is basically the difference, okay? The difference, all right, between future or forward price and spot price. So you can remember this. This is just a definition. Basis is basically a difference or spreads between futures and forward price and the spot price. Okay. So the next part of the question, first they call you to define. The second part of the question, state 3 situations that could result in non-zero basis at maturity. So there is a difference between futures and forward price and spot price. But when at maturity is supposed to be zero basis. That means your futures price is equal to your spot price. Okay? Your futures price is equal to your spot price, zero basis. So basically, in a timeline, this is time 0, this is 90 days later. Okay? So over here, there's a spot price for sure. Then with this spot price, you calculate according to the discounting rate, you can find the future price 90 days later, how much is it? So this futures price supposed to be equal to the spot price 90 days later. Okay? But there are scenarios where these two are not equal. So what are the situations which is not equal? So they given you here 3 situations. So the first one, there should be 3 mismatches. Okay, 3 mismatches that will cause it to be non-zero basis. So number 1, asset mismatch. Number 2, maturity mismatch. Number 3, quantity mismatch. So when there's a mismatching, there will be a zero basis. That means the price will be different because it's a different thing. So number 1, for example, you're actually hedging for soybean oil. But under the commodity, there's no such thing. The closest to it is soybean. So you hedge using soybean prices. So in other words, you think that it's pretty similar, but they are not exactly the thing that you try to hedge. So that is asset mismatch. Okay, that is asset mismatch. When it comes to maturity mismatch, by right, you are hedging for 92 days. Okay, but then in the futures, there's only 90 days. So you under hedge, 2 days unhedged. So the price confirm is not as accurate as it's supposed to be. So that is maturity mismatch. Lastly, quantity mismatch. You wanted to hedge for 900 kilo. Okay, but the size in the future closest to it is 1000 kilo. So in this case, you overhedge of 100 kilo. So of course, when there's quantity mismatch, the pricing will be different also. You don't need so much, but you overhedge. So quantity mismatch. Can understand? Can follow? So these are the three mismatches that will cause your basis to be non-zero. Okay? Yeah. Simple. Very easy. Can? All okay? Can, huh? I see no questions in the chat, so I assume it's okay. All right. I don't know whether you all got post any questions in the YouTube or not, if you are using the YouTube stream. But please don't post there because I'm not watching there. Huh? I'm only using Zoom here. That recording on the YouTube is for a record that you guys can refer to it later on. Then repeat the quantity mismatch. Okay, so you want to hedge for 900 kilo of gold, for example. Okay, maybe you need to buy gold in 90 days later. So you scared the gold price will goes up. So you lock down to buy 900 kilo of gold at 100,000 per kilo. Okay, but the problem is there is no 900 kilo contract. There's only 1,000 kilo contract, which is closest to you. So what you do is you lock at a 1,000 kilo pricing. So you overhedge. You got an extra 100 kilo there, which you don't need. That's why it's a quantity mismatch. So it won't be a non-zero basis. Can, Amir? All right, good. Okay, good. So now look at question number 9 together with me. I want you guys to think together with me on this situation. So number 9 is a very weird situation here. So a corporate treasurer who was long 3 months future on British pound sterling for 400,000. Okay. Subsequently, he shot 3 months forward. 3 months forward of 400,000 pound. Assume the exchange rate in both cases is equal. That means there is no difference in exchange rate. Same rates. What is his net position in British pound? Is there any gain or losses here? Is there any gain or losses here? So gain or loss or not? Come on. So imagine this person go into Guardian Pharmacy to buy 400,000 tablets of paracetamol or Panadol. Then the next thing he do, he run back to Watson and sell that 400,000 tablet to Watson at the same price. So do he gain anything? Did he gain anything from this or not? Break even. Okay, break even. Very good. So his net position is buy 400,000. Okay, buy means you spend, you buy negative 400,000. Then you short, that means you sell 400,000. So his net position is zero. No gain, no lose. So basically, doesn't make sense. Nobody would do this kind of transaction. As good as not doing it. What do you want to do this for? You buy 400,000, you sell at 400,000. What's the point? No point. Okay? So his net position is zero. He buy, that means he came out with negative 400,000, then he sell it back at 400,000. So net of zero. Okay? Net of zero. Simple. Easy. Can, the rest all can get it, Can you get it or not? Got it? Hello. Some response, please. Lah. Give me some response. Got it. Very good. You don't give me response, I don't know. You can follow, cannot follow. Okay. So, very good, very good. Thanks for responding now. All right, number 10. Explain the concept of leverage in the futures market. So, I don't know how many of you been trading before or even learned this before in other units. So, leverage means, for example, if I give you a ratio of 1 to 50, means your $1 can buy something worth $50. This is leverage. Okay. Basically, you have a certain amount of money. You are buying something bigger volume or bigger amount than you. Yeah, trading could be in stock market, could be in foreign exchange, could be in cryptocurrency, could be on derivative trading, futures trading. Yeah. So anything to do with buying and selling in the market. Okay. Yep. So in this case, leverage 1 to 50, all right, means your $1 can buy a $50 value. Okay, $50 value of stocks or whatsoever. So this leverage will assist you on getting high profit with little capital. And of course, at the same time, high losses with little capital. Okay, so they amplify your profitability and amplify your losses too. So basically, you start with a small capital, but you could buy a bigger volume of derivative commodities or whatsoever in the market. Okay, so a small price movement change will make you huge profit with little capital. At the same time, a small price drop will make you high losses too. Okay, so definitely, if any of you are interested on doing tradings, okay, we don't say this is not considered as investment. A lot of students has a perspective that they say that they wanted to be an investment banker, but what they know about investment banker, they only think about trading and trading and trading. So being an investment banker or investment person is not only on trading, okay, it's including on managing risk, all right, discipline, and also maintaining capital. If you are only interested in doing trading, so I would frankly recommend you not to go into any investment banks or whatsoever, but do trading at your own interest or as a hobby. Okay? Because in other words, actually a lot of traders in around the world, in Malaysia, or young traders that tend to speculate a lot. And speculations with leverage will make one person bankrupt. All right, this is just my advice to you guys. Okay, so who do not know who am I, I'm actually been teaching for more than 6 years in finance and also in business modeling. I myself is involved in a lot of connections or I meet a lot of VCs, venture capital, startup businesses, and also involved in trading businesses too. So I know what is the habits and patterns of a trader. What do people in bank do as an investment banker? Okay, so an investment banker, like I tell you just now, most of them, okay, they started off with managing risk management. Okay, so they do things like portfolio diversification, portfolio management, and so on and so forth. But eventually, when you become a much more experienced investment banker, you will become a fund manager. So what does a fund manager do? A fund manager will manage the investors' fund and reinvest it into the market, whether it's going to be in property, in equity, on ETF, on small stocks, penny stocks, or whatsoever. They are investing people's money, okay, to make sure they can maintain a certain amount of profit. All right. So investment banker could also be independent fund manager. That means you manage a big profile of funding or pooling of money and then do investment for them. So another one Investment banker will also be the managers of mutual funds and unit trusts. Low risk investment. Yeah. So a lot of things that an investment banker do. It's not just about trading, you see. They do portfolio management, they do research analyzing, they do credit management, they do a lot of research also. Yeah. So I hope that you have a better idea on what is it about, Sean, now. Okay? Can, huh? All right. Okay. So done with leverage. Let's move on to 11. 11 is a very similar question to what we did before. What is the importance of the speculators in the futures market? All right. So I told you just now, speculators will provide liquidity and also the counterparty of hedges. It's the same as the previous question just now. Okay. So no need to, repeat too much of it. So coming to the last question here, contango and backwardation. So this one, you just remember what is it about. So contango basically means, okay, uh, these two also means the market situation or market trends. Both also represent a market situation, but for contango, is where a situation where your futures price are trading higher than your cash price. Okay, your futures are more expensive or trading at a higher level than the cash price. Backwardation is also a market situation, but it's the opposite. Futures price is trading cheaper than the cash price. So these two just need to memorize. Okay, there's nothing to be tested here. No one gonna ask you anything as well. They will just call you to define contango and backwardation. That's all. Okay. So that's basically a wrap up for today's tutorial. Unfortunately, we only spent around 1 hour. Okay. So if any of you have any questions that you want to clarify with me, please feel so to voice it out to me now. Okay. Whereas those who are okay with today's tutorial, you think you can understand well, you may dismiss early, but I'm not forcing you to dismiss early also. You want to stay, you think you want to value for money, you already paid for 2 hours, you want to stay for 2 hours. It's up to you. You can stay with me. I'm here. Okay, we will need to chat